On Wednesday evening, the Federal Reserve cut its benchmark interest rate for the first time since December 2024, lowering it by 25 basis points to a target range of 4% to 4.25%. Chair Jerome Powell signalled that further cuts are likely this year, though the pace will depend on incoming economic data. To discuss what this decision means for the markets, the economy and politics, I'm joined today by StoneX Senior Advisor Jon Hilsenrath. Thank you for joining us, Jon.
Thanks so much for having me.
So first question, Jon, why did the Fed decide to cut rates?
Well, the Fed's getting a little worried about the U.S. job market. You know, we've been in this mode for much of the last year or so of what I call labor hoarding, where companies aren't hiring much and companies aren't firing much. But what we've seen over the last couple of months is labor hoarding has become more like labor trimming. We've seen almost no job growth in the United States. We've seen the number of unemployed people start to exceed the number of job openings. And so the Fed is trying to bring down interest costs to make sure that a worsening job market doesn't feed on itself.
And a brief word about dissenting views. At the end of the July meeting, Fed Governor Chris Waller and Vice Chair Michelle Bowman dissented, pleading for a cut. But Wednesday showed a more united front. What were the political dynamics around this rate cut?
It certainly was more united, and you're certainly right to focus on the political dynamics because we've been talking about that a lot here in Washington over the last few months. President Trump wants to place loyalists on the Fed board. He wants a Fed that's cutting interest rates much more aggressively. He has a new governor, Steve Mirren, who dissented because he wanted much more aggressive interest rate cuts. But what was interesting, as you said, is two other Fed governors who dissented back in July went with Jerome Powell this time and said, all right, let's take this slow. And that signals some support for the old guard at the Fed. I think the message from that is that maybe the president's desire to very quickly turn the Fed into an aggressive rate cutter is going to be harder to achieve than the president and his supporters were hoping for.
Going back to the Fed policy, what are the risks ahead for the US central bank and the economy?
Well, there are a lot of risks because, on the one hand, the Fed is cutting interest rates to try to support a weakening job market. On the other hand, the Fed has a 2% inflation target, and inflation is coming in around 3% right now. And we're still waiting to see the full and longer term effects of tariffs. So the big risk is that the Fed cuts interest rates and inflation goes up and it fails to achieve its 2% inflation target. You know, the forecast that it put out for 2026 were kind of interesting. The Fed is projecting the unemployment rate will come down a little. It's projecting economic growth will speed up a little. Under conditions like that, you would think that inflation would rise a little bit, but the Fed is forecasting inflation will come down next year, and there's a risk it's going to be wrong on that projection.
And how did the financial markets react to the decision?
Well, you know, the decision that the Fed made was really priced in to the markets going back to Jay Powell's speech in Jackson Hole in August. Everybody expected it. The question that people had was, is the Fed going to pencil in two more rate cuts for 2025 or one more rate cut? And what we saw on that front was more division. About half of the people wanted two more rate cuts, and another half wanted one more rate cut. The median by one vote was two more cuts. But I think the message is that the Fed is still watching the data very carefully. It still has a lot of uncertainty. It's leaning towards two rate cuts for the year, but it wouldn't take a lot of very big surprises to get it to pull back a little bit, either on the job front or the inflation front, and just do one.
And looking ahead, what should investors and households be watching for?
Well, my focus is very much on the inflation story. You know, inflation has not been at the Fed's 2% target since 2020. So, and they're projecting out to 2027, still not getting it. The markets in the United States, stock markets, bond markets, have a very benign view of the economic backdrop. I think some disappointments on inflation could upset that benign view. So I'm watching those numbers very carefully.
Well, thank you very much for your insights, Jon. Great to talk to you.
Thank you.
For more videos like this, please do like and subscribe.